Hello and welcome to the Harwood Report for September 4th, 2018. I'm Keith Harwood, the founder of Trade Academy. As a reminder, standard disclosures here. All content and services are provided for educational and information purposes only and are not intended as legal or financial advice. Please take a moment to read through the rest of these disclosures to make yourself aware that I am not giving any sort of trade recommendation here, just talking through my personal thoughts. And that's what I'm going to do next. I'm going to talk to you guys about where I'm seeing the S&Ps, the Qs, IWM, because I think right now the market itself is getting a little more interesting. TLT had a big move today. Silver got destroyed. Take a look at the metals there, and then let's see where we're gonna go in oil. It's a little bit of a choppy trade today. Started really firm, and now it's backing off a bit. So, let's get straight into this stuff. First, I always start with fear and greed. It's at 65. When we've seen the market making these new highs in the past, I tend to see that increasing amount of greed. So why isn't it showing greed? Well, frankly, people are hedging. You can see the put and call options are still there. The VIX is still neutral. So people seem to be hedging into this rally. That doesn't actually mean anything bearish by any means. It means that people have a hedge on. It makes it a lot harder for this February 6th type event to happen because people have puts below the market most likely. They're also not necessarily selling calls, so they don't have that need to turn around and panic buy the market like we saw in January. This looks like it may just be kind of what we saw at the end of last year. A little grind out to the end of the year, and then maybe into the beginning of next year we do the same sort of explosion, or maybe we have to get through the next elections. I'm not sure exactly where it's going to happen. But today's move, just a little pull back to the 10-day moving average and then bounce. Nothing really bearish here in the market. When I look at the VIX, it's near lows, but like I said, we're seeing hedging here. It's not at the lows. I would have expected with new all-time highs to see VIX cash maybe even below 11, maybe even below 10. So, we see this low that happened back in August, 10 and change, 10.17. That's the kind of move you'd normally expect when you're seeing sort of over-exuberant buying. So maybe that'll come about here in the next couple of days, couple weeks. But for now, the market is still putting hedges on just in case we get that next pullback. So how do we trade that? We look at the options space, and I think that there are some bullish plays that use the term structure for that. That's how I'm approaching this market. I mentioned the premium newsletter in previous videos as well, and I'll mention it first here. The premium newsletter is where I really go into the trade detail on how to do those calendars and diagonals and things like that. So if you're looking for a sort of trade structure that I'm looking at here, why don't you sign up? You get your first week for free. So if you get a free week, you can get a little bit of a sense of how I look at these markets when I see stuff like this. The Qs, always interesting. It had been a lagger, had a nice little breakout, didn't even retest the 10-day moving average. Just a little pullback today, back to basically unchanged. There's nothing too bad about the Qs today. SMH, I think, is an interesting and important part of the Qs. You see that we're retesting the August high here from August 7th. Or August 8th. So, for the tech sector to really get firm here, I think that we're going to have to see some more buying in the semiconductor sector. That's, the NVIDIAs, the AMDs, Micron, things like that. And if that comes through, that's going to help provide another tailwind for the market overall because people love it when tech's running. But more importantly is when small caps are running. Now, we're getting a little bit of a pullback today in small caps. That's a little concerning. You can see that we've gotten hit here and we're trading near these lows. But again, it's just at the 10-day moving average. So it's part of that little consolidation, money rotation. Nothing really, frankly, all that bad. The nice thing about IWM is that the volatility there is actually some of the cheapest in the landscape. So if I pull over here, this is Sterling Vol Trader for those of you that aren't familiar with it. We look at the volatility. The red line is implied volatility. The blue line is historical. So this is the consolidation, not the movement here. Red line wise, volatility is pretty close to lows here. 11.5 is about as low as it gets. It's pressing towards 13, so it's a little higher. But if you compare that to say the Qs, the lows here were 12.5, and it's pressing towards 15. So it's just a little nuanced. I think IWM's got the cheapest vol in the landscape. A lot of times Qs and IWM vol are pretty close to inline. Qs have been a little higher, especially because people have been worried about getting their hedges because of that February 6th event. I wouldn't be surprised to see that revert to the point where the tech sector and small caps end up having very similar volatility levels. Let's keep going through the charts. TLT is important because of the move it had today. So I've been looking at this as a sort of a strangle play with vol really, really cheap. and doing so with a bearish bias, and that came to fruition today finally. So, looking for something, I was basically playing with something that looks like it would break through the 121 level. We jumped all the way down to 120. Now I kind of see this getting back here towards this 118 level. You can see where we traded a lot in February, March. Recent low here in August, late July, early August. So that seems to be a decent target level for me. Volatility did come up a little bit here, but it's still relatively cheap in TLT. You can see here that TLT vol, the low point last week was basically 8%. That was just ridiculous. Anything under about 8.5 is pretty cheap. We're pressing towards 9 again here, and I get it. The realized volatility has been pretty low. That's actually also telling us a little bit, I think, about the macro world. If bond volatility isn't that high and there's no real panic in the bond market, then that probably tells us that this equity stuff continues to be, maybe a little bit of an overreaction relative to the rest of the macro environment. So that's something that I also keep in mind there as I'm looking through my structures and how I'm thinking about the overall direction of the trading world. Before I go to gold, I always want to start with the dollar. So first, the whole dollar index you can see is very strong. And if I go to dollar yen is actually very strong today after, just getting a little pullback. I'm looking for this to get back up towards 112.77, 113 range. And in the process, that would put gold back to lows. But the real signal for me in gold is what's happening in silver. I mean, we see what happened in silver here. That just got destroyed today. So you see how much further down silver has already gotten hit. We see what's going on in the miners. The miners are at recent lows here. So all of these other things have already gotten hit. Gold got a little bit of a delay this time. Usually I've seen gold kind of lead it. So maybe this liquidation event is kind of coming through here. For me, it's really a no trade in silver and the miners because they're already at such cheap levels. And it's a minor trade to the bear side of gold, looking for a play back down towards 111, 111.5, and then reevaluating from there. Finally, oil. Oil is, it's a kind of a weird day for it. It's unchanged. It had a firm morning, and then it pulled back a little bit here. Overall, I'm kind of thinking that we're going to get that last 3% in oil that gets us to the recent highs. That should then, in hand, put XLE to the highs. And wait, this isn't anywhere near it. So there's some leverage here in XLE. Even more leverage in OIH because OIH is so close to the lows in spite of this oil rally. You got to think that all of the oil sectors get benefit of a higher oil price. XOP has been pretty highly correlated to it, and even that has lagged here. So I wouldn't be surprised to see all of this stuff get a little bit of money flow into the end of this week, especially if oil comes out firm with the oil number on Thursday. It's doing Thursday instead of Wednesday because of the holiday, the long weekend. All right, so we've got a general sense here now. I'm thinking a little bit on the bullish side overall for the markets. Bonds drifting lower, gold drifting lower, and I think the oil stuff should drift higher initially, and then it may start to spike. And if you want to know more about how I'm looking at that from an options perspective, you sign up for the Harwood Report. You get the first week for free. After that, it's only $49 a month. If you get a good sense of how I'm trading these things, generally speaking, I'm looking for big leverage out of my trades. So there's a lot of ways to make a lot of money if you understand the concepts and then apply that to your own trading style. Sign up now at tradeacademy.co/Harwood Report. Take a look at it, see if it's of value to you. And if you don't like it after that first week, you just go ahead and cancel. But I think that there's enough value here that you're going to really like this, really enjoy it. You take that first week free, continue on, hopefully make some money and learn something in the process. All right, folks, if you have questions, you can email me, keith@tradeacademy.co, or you can always call me, 312-600-8004. Have a wonderful rest of your day. And take a look at the Harwood Report Premium. The newsletter's already been posted, so take a look and see what you think.